Bismillahirrahmanirrahim. So today we are going to start on this new book. It's by Randall Ray, one of the three authors of the MMT textbook that we have gone through, and the title is Why Minsky Matters. So this Hyman Minsky was the not very much attention was paid to him until the global financial crisis, which followed very much the pattern that he had described. So a lot of his ideas are not understood, although a lot of people talk about it. So I wanted to go through this book so that I would understand. So after the global financial crisis took place, many people called it a Minsky crisis because it follows the pattern that he had described. But what is a Minsky crisis? This is what we'll see. So basically, the Queen of England went to the London School of Economics and asked, why did no one see it coming? So the answer given by the authors of the textbook, Randall Ray meaning, he says that, well, in order to answer this, why did no one see it coming, you have to look at a lot of things like how did macroeconomic thought evolve in the period coming up to the thesis, in particular the rejection of Keynesian economics, the coming of monetarism of Friedman, the Lucas, who put things in even more extreme. Lucas said that all markets equilibrate instantly. So whereas Friedman was allowed markets to be out of equilibrium for a little while, he said that no, they are always in equilibrium, and there is rational expectation and lots of other extreme ideas, which is why Solo said that this guy is a madman. He's like someone who thinks that he's Napoleon Bonaparte. So then there was the new monetary consensus of Bernanke. Bernanke said that now we know why the global Friedman had provided a hypothesis which is of why the Great Depression happened, which has nothing to do with reality, but basically Bernanke thinks that that is the reason. Actually, as my own analysis shows, Keynes also did not get it right, and Keynes have one part of the picture, then there's Fisher's debt deflation, that is another part of the picture, and when we study Mia and Sufi, we will see that there are some other elements which are missing from both of those stories. So but I think that at this point we have a fairly good, after studying this, we will have a fairly good handle on why the Great Depression happened and also why the global financial crisis. So Minsky is a very important part of this picture, which is not available elsewhere. So that was the consensus. So after the global financial crisis occurred, Bernanke applied this theory. He said that, well, this is why it happened, so this is what we have to do. Basically, what was this theory? Friedman said that the actions of the Fed reduced the money supply, and that led to the recession. And if the Fed had not done this, then recession would not have happened. So Bernanke went to the max. He put in trillions of dollars of money into the supply, and that did have a good and beneficial effect because that was one part of the picture, but it was not the whole thing. There were many bad effects, and basically he could not prevent the recession. So basically you could say that for Friedman's theory was proven wrong, because although it was one aspect, the main thing that we wanted to do, prevent the recession of the economy, was not caused by the lack of were not caused by the wrong central bank policy in that direction, which is what Friedman thought. So this is something which is very extremely important and not very well known, because the models that you study don't give any clue as to the importance of money. Friedman, of course, believes in the neutrality of money. So then there was the efficient markets of pharma, which led to complete neglect of what was happening in terms of inflated prices in the housing market. So people thought that this could not happen. because markets are efficient. So the idea that there is a bubble in the market and it might burst, this was brought up by many people, and it was rejected as being wrong because it doesn't follow the theory. So in fact, these guys, they went and said that the models that we used to look at reality have proven wrong after the crisis. Regulation was not considered important because they thought that markets regulate themselves. So all of these things played a role in making the crisis possible. You see, there are two questions. Why did the crisis happen? And the second question is, why did economists not see it coming? So these are two different questions. So the economists, the theories that they had were blinders. They made it impossible for the economists to see what was happening, and these theories are still being taught. So basically, with these theories, it is impossible for the economists to understand why the crisis happened. There is a book about the 7 different schools of macroeconomic thought. None of the 7 have any possibility of understanding the crisis because they don't pay any attention to the crucial details. So there is a very nice passage in the book that I wanted to just show. What passed for macroeconomics had little to do with reality. It was based on rational expectations in which everyone bets right, maximize everything, and while living in a world without financial institutions. There are no banks in the macro models. There are no financial institutions. There are no bubbles, no speculation, no crashes, no crises. Everyone pays all debts due on time because they so in short, expecting the Queen's economists to foresee the crisis would be like putting flat earthers in charge of navigation for NASA and expecting them to predict the points of re-entry and landing of the space shuttle. The same can be said of the US President's Council of Economic Advisors. Also, just like the Queen of England went to LSE, so the Congress appointed a committee to investigate the failure of economics, and the terms of reference for the thesis for this committee, which asked for testimony from many major economists, and Solow also testified and said that this DSG model was the culprit because it makes it impossible for you to understand what was happening, because in the DSG model there is only one agent, and the whole economy is this one agent. So it's not possible for one agent to deceive the other agent, which is what happened, because there's no other person. So the terms of reference for this committee was that how is it that not only that economists didn't predict, actually they confidently predicted that the crisis would not happen. So many people who came with warnings and were rejected, that no, our theory tells us that there is no. So this is the problem that they wanted to fix. So the key contribution of Minsky, one which is not at all realized by and understood, Minsky said that stability is destabilizing. So that the degree to which economy achieves what looks like robust and stable growth, this is setting up the conditions which makes a crash more likely. So once you have a stable economy running smoothly, this is what creates, it changes behaviors, policy, and business opportunities, and these changes create instability. So to illustrate this, the book talks about a lot of cases in which, in 1929, Irving Fisher announced that stock market had achieved a permanent plateau and there is no more possibility of market crashes. Keynes also said something similar. In fact, before the crisis, he was also a classical economist, and he said that now we are clear and there's no problems, no economic problems in the foreseeable future. In the late 60s, Keynesian economists like Paul Samuelson said that now we have learned, I was there in the 1970s, that we have great macroeconometric models. They tell us to the last detail what's going to happen. Now we have to fine-tune the economy to but the big picture is in our hands. There is no more issues left for us to solve, and so there's now we understand how to control inflation, and now we understand how to prevent recessions. So none of these will happen. And then in '73 there was stagflation. In the middle of 1990s, the Greenspan said that now we have a new economy and there is no possibility of crash and inflation. And then again, there were many crashes. There was the dot-com bubble, and which occurred in 1999, and many other problems. In 2004, Chairman Bernanke encountered that the era of the great moderation has arrived. Recessions are mild and financial fluctuations will not occur. Basically, we have conquered and tamed the business cycle. There is no more business cycle. And Lucas also announced that we have solved the problem of recessions. So, and then the great crash happened. So every time you see that economists are saying that, okay, now we have conquered the economy. So this is exactly a confirmation of the Minsky theory, that stability itself creates the conditions for instability. So how this happens, this is what we are going to study. So in every case, there was a lot of evidence to support the belief that economy and financial markets were stable. Good times have come and they will continue indefinitely. And economists have finally gotten it right after having made a lot of mistakes in the past. In every case, these prognoses were completely wrong. In every case, the stability itself created this. This is the key insight which is not available in the mainstream. That stability, it was not that the stability, in fact, Steve Keen has a model of differential equations which creates a situation where you have a long period of stability followed by instability. So this is a model, but this doesn't capture the Minsky hypothesis that it is stability which creates the conditions which lead to instability. And that's what we'll see. So basically, Minsky's theory strongly integrates financial markets with real markets, and this is something which is not available in mainstream, because basically mainstream is very strongly wedded to the idea that money is neutral and money is an illusion and money is a veil. So basically the right way to analyze the economy, if money is an illusion, is to throw out the financial markets, because they only distract from the picture. The main picture is the real economy, the factories, the financial is just a distraction. So your mainstream macro models don't have any banks, don't have any financial sectors, they don't have any debt, they don't have stock markets. All of these things are distractions. The real economy consists of the factories, the laborers, the capital, the resources, the energy, etc. So Minsky had an understanding of banks and financial markets. Not only did he see it coming, but he also warned that it could happen again, and he identified in real time those financial innovations which would create the conditions which would lead to the GFC. So he identified things which were happening which would actually cause problems. But nobody paid attention. He was like the Cassandra. After the crisis, there was a financial crisis inquiry report. In the report says that the crisis was foreseeable and avoidable. It did not just happen, and it was not a black swan with a fat tail. Black swan theory is a very important theory created by, what's the name of this guy? This is this Lebanese क्या नाम है उसका, किसी को पता है? राइट, अब मैं बूढ़ा हो गया. तो alright, we'll discuss the black swan later. It was actually created by the biggest banks under the noses of our regulators. If the regulators had been doing their job, this wouldn't have happened. But the regulators had been captured by the banks, so they were, and this is something which happens commonly. Regulators are paid government salaries, and the industry they're regulating makes millions and billions of dollars, and so it's very hard for them to resist temptation. And basically what happens is that they get big jobs in the industry after they finish regulations. So, in contrast to what some of our people think, that they are always honest and there is no corruption in the USA, and this is just 180 degrees opposite to the truth. So the economist at LSE told the Queen that, these things just happen. It's like an earthquake. Nobody can predict them. So this is completely false. So the inquiry report says that the global financial crisis was a dramatic failure of corporate governance. Everybody was doing wrong things and on a large scale, and this is also, and it was easy to see that they are doing wrong things, but they were all collaborating in the game because they were all making big profits, and the regulators were also in on the game, and they were also getting their own share of the pie. So actually there were lots of criminal actions, but they were never prosecuted except in Iceland, where they actually put some bankers in jail for fraud. But there was enough evidence for criminal fraud in all the places, but like a bank which had done $50 billion fraud, they were fined $50 million and things like that. So the financial lobby is in control of the government basically, so nothing can be done. So there was lots of gambling going on. There was rapid growth, which is a indication of fraud. If the economy itself is growing at 3% and you can make financial returns at 10%, then some fraud is going on. The biggest banks were aided and abetted. They were helped by the government regulators. Not only did they refuse to do their job, but they actually lobbied the government for more deregulation and desupervision, contrary to what they were supposed to do. There were lots of evidence for this in different places where basically the regulators were, instead of acting in behalf of public interest to control the financial sector, they were acting as lobbyists for the financial sector against the public interests. The economists pushed for the opposite policies to those required. Larry Summers, son of Robert Summers, who was my colleague at University of Pennsylvania, I asked him, Robert Summers is the brother of Paul Samuelson. So I asked him about his name, that how come, he said he used to be Robert Samuelson, but he said that, people would ask me, well, are you any relation to the famous Samuelson? He didn't like that. He didn't want to be known as the lesser Samuelson, so he changed his name to avoid this problem. So he was his son. He was going to Harvard at that time. So he pushed for the deregulation, and he pushed for free market. He actually bears a large part of the responsibility for the global financial crisis. He pushed policies very strongly. There was a meeting in which Raghu Rajan, the ex financial minister of India, who is actually I think in some university in the USA, well-known economist, he said that he wrote a paper saying that there's a lot of risk in the financial system and it is increasing, and so Larry Summers laughed at him and basically ridiculed him, and then everybody ignored him until the crisis occurred. So warnings were not only given, but they were ignored. So basically, there's a dynamite prize that was heterodox economists said that who are the people who are most responsible. So there are three names: Friedman, Greenspan, and Summers, who received the dynamite prize for blowing up the economy. They are all very. They all played an important role. So the global financial crisis, the conditions were quite similar to the Great Depression. In the conditions leading up to the crisis were quite similar. So anybody who had understanding of the global Great Depression could have foreseen that the global financial crisis is coming up. But unfortunately, nobody had understanding. The understanding that existed based on the monetarist view was completely wrong. But that was the understanding which Bernanke was operating with. And so, however, the response was very different. Of what happened after the global Great Depression was very different from what happened after the GFC. The government created a $1 trillion deficit to use the policy to fiscal deficit to fight against the Great Depression, and there was a $29 trillion bailout given to the banks. So, and this was the effect of the Bernanke hypothesis that basically you give all the money needed to prevent the recession. Now, notice how different this is from the East Asian crisis, where the same kind of thing happened. There was a financial crisis, and instead of increasing the deficit, the government was told to decrease the deficit, even though they had no deficit problems. And instead of being given a bailout, which would have the IMF isn't the job of giving bailouts in the sense of providing them with financial liquidity so that they can handle the crisis. They were actually told the opposite things. So there was, despite all of this response, there was a terrible recession, which continues today with high unemployment and 25 million loss of jobs, which have come back, but there is a huge amount of underemployment. People are not working, and so this is why the employment figures are misleading, and people are puzzled about why, even though employment has recovered, productivity is quite low, and the reason is basically because people are not working at full-time jobs. They have this kind of like Uber jobs, which sometimes they do and sometimes they don't, and so these are not full-time 9-to-5 jobs. And so despite the fact that millions were made homeless and millions were made hungry, so there was social welfare programs which were in effect as part of which were enacted as part of the New Deal after the Great Depression, and these were so they prevented mass starvation and hunger that happened after the Great Depression. Millions were homeless, and there are many mortgages which are underwater. You know what underwater mortgages are? I think I explained it some time ago. No? In a mortgage, you take a loan for a house which is worth, let's say, $1 million, and you promise to pay them $1,000 a month for 30 years. That will be more than that actually for $1 million. But now, suppose that you have paid already a lot of money, $500,000, and now to the company, because you're paying principal and interest. So you have acquired some equity in the house. You have paid principal up to something like, let's say, $300,000. Now the housing market collapses, and the house is now worth $250,000. So now your equity in the house is already more, but than the worth of the house, but you still have huge number of payments remaining to make. At this point, it's worth it for you to just walk away, because what you end up owning will be less than the amount that you have to pay. This is called an underwater mortgage. So there are huge numbers of mortgages which are underwater. And so now the person who's making payments, he has to decide every day that why should I make, and I'm buying something which is worth $100,000 for $200,000. It's better to just walk away and use the money that I'm going to pay to buy something which is worth what I'm paying for it. So officially, recovery has happened. Officially, the unemployment rate is now in a reasonable amount. But actually, this is just an illusion, because basically the labor force has shrunk, in the sense that lots of people, and basically labor force is the number of people who are looking for work. Lots of millions of people just gave up looking for work, so now they are no longer in the labor force because there were no jobs around. So home ownership rates, employment rates are well below where they were before the global financial crisis. Inequality has increased, and whatever little growth the economy has done, all of the gains have been captured by the top 1%. Another thing which did not happen, which did happen after the global Great Depression, was that there was very strict regulations enacted on banking and finance to prevent this. This did not happen. Lots of attempts were made, but actually they were defeated by the financial lobby in the Congress. So basically the financial lobby is in control of the Congress. All of the problems that created the GFC are continuing, and they are even bigger and more dangerous today than they were on the GFC, just before the GFC. The stock market is inflated again. The housing market bubble has again reached quite a high proportion, and there has been no change in regulations. So it doesn't seem, and also the economic theory has not changed. So Krugman is an apologist for the mainstream. He says that, so these heterodox economists, they have it all wrong. They are saying, there's some fundamental flaws in economic theory, and we need to fix that. He says this is all wrong. That's not true. The mainstream theory is quite right. What happened then? What is the problem? The problem is that there was a huge shadow banking sector which emerged, and nobody noticed it. If we had noticed that there is a shadow banking, then we would have been able to fix the problem. So what is shadow banking? This is something that you need to know. Basically, in the 1933, after 4 years after the Great Depression, the 1933 Banking Act was passed, which made a lot of laws regulating the banking industry, making sure that the banks did not grow too large, and that they did not pay too much interest, because competing with each other to pay high interest was one of the causes of the GFC. So there was a cap put on interest, and many other regulations were made. One of them was the Glass-Steagall Act, which was part of this Banking Act. And the Glass-Steagall Act was a very simple 6-page act which says that banks cannot speculate. They cannot enter stock markets, they cannot do anything, they cannot invest in overseas, they cannot do anything which is risky. They have to take. That's why banking was very conservative. They only made solid investments in treasuries and in other sectors where there was no risk. So in 1999, the Graham-Leach-Bliley Act was passed, which repealed the Glass-Steagall Act, and in 2000 the Commodity Futures Modernization Act was passed, and both of these acts basically deregulated the banking industry and allowed the creation. This was a 1-2 punch. In the one case, the banks were allowed to speculate. In the other case, the Commodity Futures Modernization Act, it created a sector which was not subject to regulations. Basically, derivatives, for example, it allowed derivatives, which we will discuss shortly, to come into existence, and there was nobody to watch. The regulatory laws were still applicable even after the repeal of Glass-Steagall, and they might have done some good. So when the banking sector created a sector which was not subject to regulation, and then the derivative came into existence. And so there is the shadow banking is unregulated activities by regulated institutions. So banks can create subsidiaries which can do things which nobody needs to watch, or new institutions can come into existence. Again, they can do a lot. They can do all of the things that banks do, but they are not subject to regulations like banks. So one of the important things which led to the financial crisis was the credit default swaps. This credit default swap is suppose that I am a bank and I am owner of a mortgage. So what I have done is I have given a loan of $100,000 to some person for a house purchase, and what I own in return for this is a stream of payments that's coming in. Every month this man is going to pay me $1,000. Now there is a possibility that this man will default on the payments. Maybe he loses his job, maybe he gets sick or something or the other. So maybe his business collapses. So what I can do is I can sell an instrument, this is a derivative, which will to some other institution, which will insure me against the possibility of a default. So now I take this $1,000 that's coming in and I say, okay, every month I will pay you a premium. This is like an insurance. I will pay you $100 out of this 1,000 every month, and in return what you do is that if this man stops making payments, you will make me the payments. So he takes the risk which is I have, and he buys this risk, and in return he gets the premium that I would pay him. So with the credit default swap, so it's like now the credit default risk that belonged to me now belongs to you. It is important to note that the credit risk has not been eliminated. If the mortgager refuses to pay, then the person who sold me the swap is going to pay. But now the point is that even that person can also default, and that is exactly what happened. Very big institutions like Lehman Brothers, Bear Stearns, and AIG, which is the largest insurance company in the world, they defaulted on their credit default swap obligations. So they were supposed to insure, but they had taken risks which were far beyond the capacity of anybody to handle, and so ultimately they also defaulted. So on the one hand, I had default from the person who was trying to pay the mortgage, and then there was the default from the insurance institution which was supposedly insured me against this risk. So I've written a note that in the Islamic economy there is no trading of debt. If I have debt, I cannot sell it. There is no contracts with gharar, which is uncertainty, high uncertainty. There is no interest payments and no gambling. So all of these rules, if they had been enforced, there was the crisis would not have occurred. It's very simple. In fact, there was an article in a French magazine saying that the Quran offers us much more guidance than the Pope in terms of what happened in the crisis. So there's widespread understanding that Islamic financial regulations would have prevented the global financial crisis. So basically, Krugman analysis is based on two mistakes. He does not understand banking. He believes in financial intermediation. So when you have financial intermediation, then the banks don't play a role. They are just a pass-through mechanism. I deposit money in them, they take this money, they give it to somebody else. So basically, in a model, if I take this out, it doesn't really matter because I can directly give money. So it doesn't happen like that, but in a model, putting an intermediary out of the picture will not cause any serious problems. But so he does not understand banking, he does not understand finance, and he does not understand Minsky's critique. He says that Minsky matters only peripherally. Even if all of the things that Krugman said that we made mistakes on were there, Minsky's critique would remain. And basically the key difference is that Krugman believes in equilibrium, and Minsky says that equilibrium itself is destabilizing. So once you are at equilibrium, this being at equilibrium generates the forces which throw you out of equilibrium. So this is something which Krugman does not understand, despite being a Nobel Prize winner. So what did the mainstream say? Their mea culpa means I am guilty. Yes, they agreed that they did not understand the crisis, and they have three excuses for why they did not foresee the crisis. So one of these excuses is the Black Swan event. So Nicholas Nassim Taleb, this is a Lebanese guy, he invented the Black Swan theory. Basically, what's a black swan? You see, this is one of the important concepts to understand, that the logical positivists thought that there are two types of truths. This thought is a mistake, but this thought was widely believed. There are two types of truths. There are analytic truths which are true by the virtue of definitions, so they are true by logic alone, like 2 plus 2 equals 4. Once you know what 2 is, once you know 2 is, once addition is, then you will come to this. And this does not, so the analytical truths do not have to do with the empirical reality. And then there are empirical truths. Empirical truths are those that you learn by observing the world. So this is a big mistake in understanding what the nature of reality, but this was widely believed by the positives, and this was the basis of the both modern econometrics and modern economics are founded on the philosophy of logical positivism, which is absolutely false, and that's why modern economics and modern econometrics are also fundamentally flawed, beyond the possibility of repair. So the synthetic truth, there are analytic truths which are purely logical, there are synthetic truths which are true by the virtue of observation. So the most famous example of a synthetic truth was that all swans are white, because in Europe they had never seen a black swan. So when they went to Australia, they discovered black swans, and these were genuine swans in the sense that they could interbreed with the white swans of Europe, so they were the same species. So this was a completely unexpected event, because up till that time all of the empirical data says that all swans are white, and this was supposed to be an analytical truth. So this also illustrates the weakness of the idea of a synthetic truth, that how can even if for the past billion years sun has always risen on the planet, tomorrow it might not rise. So there is no such thing as a synthetic truth. So this is the the black swan events are those which the previous data does not prepare you for. And then a fat tail event is one in which basically there was this major crash in 1993 or thereabout, where there was this hedge fund run by Nobel Prize winners, in which what they did was they used their models to calculate risks, and they said, the normal bankers, they are basically the bankers were doing the stock market, in the stock brokers were doing were not taking huge risks. So these people, they came and they said that we can calculate the probability of these risks, and on the basis of their normal distribution theory, they said that okay, we calculate and we take those risks, and they are so and by taking these risks, they had huge income. They outperformed all of the stockbrokers by a large margin, and they got a lot of money into that hedge fund. There is a book about that too, which I've forgotten the title about. But anyway, so people asked them what their technique was. That they said that actually this is discussed in the Nicholas Nassim Taleb book, that we are picking up coins from the road, but which nobody else bothers to pick up, and that's why we are making. They were actually playing with small margins. They calculated what the market equilibrium value of the stock is, and they calculated the actual price, and then they said, okay, if there's a difference, then we will use this difference to predict that the price will move towards equilibrium, and once you have a prediction about the stock, then you can make a lot of money about that. So if their prediction is correct, that stocks move towards equilibrium, then you can make a lot of money. So they said that we are making a lot of money. Everybody knows that this is equilibrium. It was possible to calculate those equilibria, but the market. So they said that we are taking these returns, and then they use leveraging to take a small gain and make it into a huge gain. You see, if you can make 1% on $1,000, then that's a 0.1% profit. But if instead of $1,000 you put in only $100, then now it becomes 10 times the gain, and that's what leveraging does. It allows you to put in much less cash and get the same return, because the $100 is leveraged to be and act like $1,000, backed by the collateral of $1,000, which is in the form of the stock itself. So when this hedge fund collapsed completely because of the high risk, and some of the stockbrokers said that, look, you're picking up pennies, but there's a big steamroller which is coming behind, and one of these days you're just going to get flattened. And this is exactly what happened. We are not picking up those pennies because there's a huge risk involved in going and picking up those pennies, as they found out. So when people asked them that, what happened? So they said that, well, you see, a 6 sigma event occurred. So now if you look at the normal distribution, the probability of a 2 sigma event is about 5%, and 1%. Probability of 2 sigma is 5%. 3 sigma is around 99.9%, so 0.1%. 4 sigma is, and at 5 sigmas you get 1 in trillion, and 6 sigmas is like 1 in quintillion. So even if the whole universe, the time that would take for one of these events to occur is more than the time that the universe has been in existence. So they said, this 6 sigma event occurred. This was, according to our calculations, this should never have happened. So basically they said that this is a fat tail, yani the tail of the normal distribution goes to zero very rapidly. If you have a big a distribution fat tails like the Cauchy, I've demonstrated this to my statistics classes, that you take a normal distribution and you run it 1,000 times, you will never get the number 5. But if you take a Cauchy distribution and you simulate it on your Excel spreadsheet, and I did this, so the first number is 3, the next one is -7, the next one is 30, the next one is 29, the next one is -74, and then you get hit with 2050. So now if you look at all the 5 or 10 or 30 numbers, you can do this as many times as you like. You can look at the 100 numbers, you look at the maximum and the minimum, and you multiply that by 10 to be safe on the safe side, and you will get something outside that boundary. So these are really fat tails, because the Cauchy distribution has this property. So if you take any model at all and you use the existing data to create some idea about what is the risk, you will get something which is totally outside. Again, this is similar to the idea of the black swan. So if you have a fat tail, then things can happen which are completely outside the range of the data that you have been observing. So basically that's something what the black swan with fat tails means is that our models did not capture the real risks. The other thing that happened was that the Federal Reserve Board kept the interest rates too low. This allowed the creation of vast amounts of credit, and this credit went into speculative activities which led to bad outcomes, and this is something that we could have prevented. And then there was a rise of the shadow banking industry which occurred as a result of this Commodity Futures Modernization Act, and this had they made high leverage gambles with other people's money. So when you have other people's money, then you can take large amounts of risks. So there is a solution based on this, that we should pay more attention to black swans and tail probabilities in our models, and we should pay more attention to monetary policy, and there should be more regulation of shadow banking. We should make sure that the shadow banking industry has some skin in the game, that they should be subject to liabilities if they make losses. But there's nothing wrong with mainstream macro theory. I also, after the financial crisis, there was a lot of seminars. I also went to a seminar on macro prudential regulations. How can we make regulations which will ensure that the crisis does not happen? So this was the mainstream response. We don't need to change the theory, we need to regulate more. So what Minsky says is that none of these things would allow the mainstream to foresee the next crisis, because the mainstream believes in equilibrium. The mainstream belief is that the market forces are stabilizing. This is what you have been studying in your general equilibrium. Oh, not, have you been studying general equilibrium? I think so. In the other micro class, yeah? Yeah. So that's what they believe. Now the thing is that Minsky believes the opposite. Financial forces are fundamentally destabilizing, and the worldview of Minsky is basically the opposite of real business cycles. The real business cycle says that everything happens in the real sector. Minsky says that the main drivers of the business cycle are the financial sector, not the reals. So basically, if you look at real forces, you cannot find them, and that's exactly what we studied last term about the invisible. The Paul Romer's critique of the real business cycle theory is based on the idea that they include these invisible forces which they don't understand, and those invisible forces are driving the business cycle. They don't explain the business cycle, they just put it out of the picture. And this is the picture. The financial sector is the driver of the business cycle according to Minsky. So if in micro you have studied general equilibrium, then you know that there's a lot of theory which goes, and basically the theory says that there is something which is in existence, and that's all. Now there is no theory about whether convergence will occur and what happens after you get to equilibrium. What happens after you get to equilibrium is that's, everybody knows that once you are in equilibrium, you stay in equilibrium. That's the meaning of equilibrium. But what Minsky says is that if you stay in equilibrium for a long time, that itself generates the forces which break you out of equilibrium. So there is no theory of convergence, there is no theory of stability of equilibrium in standard economics, and these are the things that you need. And typically, if there are multiple equilibria, So if there are multiple equilibrium, then again you don't know which one you will get to, and so on. So basically this equilibrium theory is just garbage. Alright, so we are saying the stability destabilize, but what is the destabilization? It's precisely this, that people start taking risks because they see that the environment is stable. So gradually people take more and more risks because they say, look, nothing is happening. So as the risky behavior increases, the risks to the system build up, but and ultimately they build to a point where they collapse the system. So one of the counter arguments offered to Minsky by the mainstream is that after World War II there was a long period of stability. So if stability was destabilizing, we wouldn't have seen that. But actually, if you look at closely, you see that the Minsky thesis is true, that there were crises, there were short crises, and they were handled. And this actually contributes to the confidence that yes, if something happens, people will take care of it. So the government will take care of it. So when the government is able to resolve crises, this also contributes to stability, and this also contributes to the build-up forces which destabilize. So when I was in the USA in 1970s, they had just introduced this so-called Now account, and basically the point was that previously the banks were not allowed to offer interest. There was the checking account which was had zero interest by law, and then there was the savings account. And the savings account you could get interest, but first of all there was a ceiling, maximum interest rate 5%, so the banks could not compete with each other on interest. And second of all, if you put money in your savings account, you had to keep it there for 1 month before you could get the interest. But basically people were relaxing. The banks said that okay, even if you have a savings account, you can take your money out any time, and then this, but you could not write checks on it. So they introduced this Now account, which says that okay, this is just like a checking account. You get interest on it, and also you can write checks on it. So these were the things that this was just the beginning of the innovations to get around. So basically this was against the law, but nobody was looking. And if the regulators had been on their toes, if they had been interested, they would have said no, this is illegal. But the regulators were not interested, and the banks were taking advantage of this relaxation and basically the mindset that regulations are not necessary and they are hindering the ability of the banks to earn profits. And if we allow the banks, if we take off these regulatory chains, then the economy will become more dynamic, and this will get us out of the recession. So some of the Minsky's contributions are the federal funds market developed around, I think, 70s or 80s, or maybe it was earlier, I don't remember. Basically, okay, this is the interbank market. Before the development of the interbank market, only the central bank had the reserves, and when the banks needed reserves, they would borrow from the central bank. But then they started borrowing from each other. The idea of the interbank market was that the banks would be able to produce more credit. They would be able to, because they would be able to borrow from each other. But Minsky said that this is wrong. The banks, this will not affect credit creation, because the idea was that the first bank gets reserve, then they produce credit. He says that this is wrong. The first banks made loans, then they will get the credit from wherever they need to. So these two are so getting more reserves will not allow them to create more credit. But what will happen is that the federal funds market weakens the regulatory capacity of the central bank, because when the bank gives reserves, it can check. Basically, you have to offer it a collateral that this is what I am giving you, this is what I have, banks, whenever they make loans, they have something to back up that loan. So the central bank, they say, okay, I have made this loan, I didn't have any money to make the loan, so now just give me the money so I can service this loan. So the central bank can say that, okay, what are you offering me in return for this money? So the bank will offer that this is the collateral that I have. Now this collateral was getting worse and worse over the global financial crisis, and the central bank could have stopped it. That this is too risky, I will not give you a loan. And after this, after the central bank, it would have prevented the whole crisis, because all of the banks were in the same boat. But when they were trading with each other, they were all offering each other the same collateral, so there was no difficulty. The banks could create money, and nobody could afford to be left behind in this race. So when the banks were all in the game, they were all in the game. So basically, Minsky says that this is creating additional instability, because now the risk is increasing in the system. The central bank could have stopped it, but this federal funds market allows the risk to increase because they are playing with each other. The mainstream view is that the central bank controls reserves, and then there is a money supply which is a multiplier times the reserves. And Friedman, on the basis of this theory, which was taught to me when I was in graduate school about money, I don't know, probably it has also taught to you, because this is the standard theory of money, unless they have updated the text, which to my best understanding they have not. They are still working with these theories which were failed in 1980s and known to be failures. I don't know why they keep teaching these theories which are known to be wrong. So Friedman said that basically what you should do, the Friedman Rule, is that you should allow the money, you should make sure the central bank should make sure, has only one job, is to make sure that the money grows at a fixed known quantity, like 6% per annum is what he said. So what this will do is that it will make sure that the price expectations are anchored, because the prices are just proportional to the money. So everybody will be able to forecast that tomorrow what the prices will be, and so they will be able to make their plans, what the interest rate should be, how much I should invest, everything. So this will stabilize the economy. To the extent that there are monetary shocks, money supply grows differently, everybody is hurt by this because they made plans on different basis, and now something different is happening. And so these shocks destabilize the economy, so the best thing to do. So actually this policy was followed, but it proved to be a complete failure for many reasons. One of these is that the central bank cannot control the money supply because credit creation was done by the private bank. So one of the reasons that it was failure is the bank would announce that we are going to have so much money supply, but the money supply would be way off. This hurt the credibility of the central banks, and as we have said, credibility of central banks is the key to ensuring the ability of stability banks of the central bank to stabilize the economy. So this was one of the defects of the Friedman Rule. So Minsky said that money supply cannot be controlled, but you can control the discount rate. And if you control the discount rate and you are the sole source of reserves, then you have a fairly strong control over the banking system. And then you can make sure that this you can monitor the risky behavior and make sure that risky behavior doesn't increase. So all borrowing should be done from the central bank only. There should be no LIBOR or KIBOR. The interbank market should be banned because it allows more risky behavior. And had this been done, the global financial crisis could have been averted if the central bank choose to regulate and choose to reject those collaterals which are too risky. Of course, the central bank can also be captured and has been captured in many situations, so it may not have been enough, but certainly it provides you with a tool which would have enabled you. And also, when the central bank had responsibility, it would also be in a hot seat, that it would be blamed for the crisis. This time the crisis was created by private banks acting on their own, but if the central bank had been party to this, then they would have been blamed. And because they knew that they would be blamed, they might have acted responsibly even though they were captured. So the Fed would have been aware of the risky debt portfolios accumulating in the private banks, because that debt would have been used as collateral for the reserves that they were borrowing. So the financial instability hypothesis is one of the key contributions. One of the key, there are two actually. And the financial instability hypothesis is that the business cycle that I studied, which nobody knew anything about, that why does it occur, it's the great mystery, is actually the financial cycle. And pro-cyclical lending is the central mechanism by which the business cycle occurs. So these are the terms that we will explain. So what is pro-cyclical lending? Well, basically when the economy is booming, there is a huge demand for credit, and all the banks start lending, and they can create credit at will. So as the banks demand more, the banks supply more, the financial institutes supply more credit. This is again in contrast to the conventional views which say that the central bank controls the money supply. So if there is an expansion, then the credit will not expand automatically unless the central bank allows it to happen. But this is not true. The financial assets are used as a basis for loans, and basically, as the bankers say, when economy is booming, you can't afford to say that, okay, I will control my risk, because you will get left behind. This is a competitive industry. If you say that I will not lend when everybody else is lending, you will get shot out of the market. You will lose market share. So competitive behavior makes sure that everybody lends. So there are these financial assets that you are acquiring. These are becoming riskier and riskier, but because everybody is playing the game, you are forced to follow along. It's like musical chairs. As long as the music is playing, you must keep running. But then when the music stops, then everybody scrambles for the chairs, the safe assets, but there are not enough safe assets around. So this is pro-cyclical lending, and of course there's a recession, then suddenly nobody wants to lend. So pro-cyclical lending means when there's a boom occurring, this makes the financial picture makes the boom more intense, and when there's a recession, again the financial sector makes the recession more deep, because they stop lending and the money supply contracts. And so basically one important thing to understand about this picture is that as the private sector lends more, they have higher demand for reserves, and the central bank is forced to lend them the required reserves. So the central bank will automatically follow a pro-cyclical policy. It's not in control. It is actually, so it can actually, the only thing it can do is to increase the interest rate to try to discourage the borrowing of reserves, but it cannot prevent money creation. And this is what was noticed in the global financial crisis, that the central banks tried very hard to prevent money creation, but they could not. So Minsky's theories, there are of finance, have the financial instability have two parts to them. There's the investment theory of the business cycle. So investment which is according to Keynesian theory and not according to classical theory. The neoclassical theory of investment differs very, very strongly from the Keynesian theory. And then investment happens because of finance. So these two parts of the picture are linked to each other, and that they are the basis of the financial instability. This second part, that investment is finance, is not again part of the neoclassical theory and not part of the Keynesian theory either. So the Keynesian theory of investment says that expectations about the future determine investment. So this is very simple, natural, normal. Am I going to build a factory? Well, if I think that there's going to be a strong demand for the products, if I think economy is going to boom, then I will build the factory. And if I think no, economy is in a crisis, it's going to, things are going down, if I build a factory, no one will buy my products, then I will not build a factory. So the question is, what are my expectations about the future like? Now, according to the rational expectations, my expectations reflect what will actually happen. It's not that I can predict the future. This is an important mistake. Rational expectation doesn't require that we predict the future, but it requires that on the average, people have the right picture. I may think I may be a pessimist, there will be an optimist, but on the average, the economy has the right picture. So if we take the total amount of investment, it will be roughly in line on the average, except for random errors, with what is actually needed for the economy. So Keynes said that no, future is deeply and inherently uncertain. One of the reasons for this, there are many reasons for this. One of them is that the past does not predict the future. That's the black swan idea. But the another is that the expectations themselves create the future. So if we all have a big picture, rosy picture, then that will be, the future will be rosy. And if we all have a gloomy picture, then the future will be gloomy. Once the expectations create the future, then it's obvious that this is inherently unpredictable. So it is not real. So the real business cycle model goes flying out of the window from this simple insight that if the investment is based on our consensus expectations, and the consensus expectations are not anchored, are not based on predictions of what happened in the past, then the future is unpredictable. So basically, if we are all optimistic, then there is a demand for credit, and when there is a general optimism in the economy, then the financial institutions are also part of the economy. They are also optimistic. They provide credit, and then they provide credit with high leverage and with high risk and with weak collaterals because they are confident. So that's why you can create a lot more credit if you accept collateral which you would not ordinarily expect. Even in the mortgage market, you see they screen the people who are borrowing, and they demand down payment. So if there's a house of $100,000, they say, okay, you have to give me $20,000 or $25,000 in cash, and I will check to make sure that you have a solid job, and I will require this, that, and the other, and I will, if I think there's a risk, I will ask for a co-signer. And these things happen. On the other hand, if you have a situation where you are very confident and you have collateralized risk, and you think the economy is booming, so you think that the house is a good guarantee. Even if he doesn't pay, I have a solid house within my hand, and that is worth the amount. And I also have an insurance guarantee, so everything is great, and I can give. So instead of 20%, you say, okay, you give me just 10% deposit. And I check the job, and I say, oh, he's been in the job for 2 years, and probably he will keep on the job. This is good enough. So you can weaken the requirements. You can take more risks, and this is a subjective decision. So you take high risk options. You accept weak collaterals, and you use high leverage. You can leverage is basically you give 100,000 loan with the backing of only 5,000 or only 10,000 or only 20,000. So depending on how much reserve you use, you can change the amount of credit you create. So basically, there's a lot of behavior that allows that can change, and so when you are confident, you can take a lot more risk, and you can basically, that means that you can create a lot more money, and a lot more money can flow into the economy, and that's what causes the pro-cyclical behavior of finance. Exactly the opposite kind of things happens when you are in a recession. So now as the economy heats up, a lot of money is produced, and the central bank, what it does, it hikes up the interest rates to control inflation. Now, everybody has been playing the game, and when the central bank hikes interest rates, then suddenly people get caught, because what they have, firms have been doing is that they have been taking short-term debt with the idea of rollover. This is the famous circular debt. Everybody takes it. Okay, instead the firm is making a long-term 5-year investment, but they take a loan for 1 year, and they say that, okay, next year we will refinance. So now, suddenly when the interest rates goes up, because the central bank responds, then they are caught short. This creates losses all across the economy. Money supply becomes, credit crunch occurs, and this leads to a recession. And this recession is made intensified by the banks seeing that, oh, business climate is bad, so now they say that, okay, instead of actually doing what is required, expansionary, they cut back on loans, they cut back on credit, they increase reserve requirements, they make less risky investments, and so this actually makes the recession even much worse. So there is a famous classification due to Minsky. There are 3 types of finance. There is hedge finance, which is not related to hedge funds. That's a different term. So he says that this is the case if I borrow and my earnings are enough to repay the interest and the principal. Standard mortgages, you borrow and you pay the interest and principal together, and over 30 years, all of the interest and all of the principal is paid back via a constant return. The next stage is a speculative finance. Here your earnings are enough to pay the interest payments, but not for the principal. So these were actually introduced. This was called, when in the period of stability, these were called balloon mortgages. So you have you make payments up until a certain time, and then at the end you have a big balloon. So you have a 100,000 loan, and you just make interest payments on it. For example, this is the worst case, and 1 year later you have to refinance. You have this $100,000 payment which is left because you only made the interest payments on it, and at that point you can refinance and you can get somebody else. So it's basically deferring the payment of the principal for 1 year. Now, why would anyone want to do that? Well, if the housing prices are increasing at very rapidly, and you think that this $100,000 house is going to be worth $200,000 next year, then you are very happy. Okay, next year I will be able to finance it because now I have 50% equity in the house. This is what the bank wants. So I'm offering the bank, when I go for a 100,000 loan next year, I will already have $100,000, which is the down payment is there already, in the sense that when I give the bank the title to the house in return as collateral, the bank has $50,000, and so they will give me the loan. So in a booming economy, this kind of speculative finance, that I will be able to, it's speculative because you are counting on the ability to refinance the loan. Then the third level of risk is Ponzi financing, based on the famous Ponzi scheme. You know about Ponzi schemes, I hope. So basically, this was done in Pakistan, done all over the world. Not too long ago, people started this so-called Islamic finance scheme, and they said that, okay, you give me money, I will invest it in the business, and I will give you 10% return. Now, there is no business which earns 10% per month. That would be 120% over the year, and there's just no business which earns that much profit. So people put in the money because they had long beards and fatwas, and they thought that, okay, these people are Muslims, so they will not cheat us. So these people put in their monies, and 1 month later, the person who had 1,000 rupees, they were paid 100 rupees. Now, of course, the person who is running the Ponzi scheme, he just collects all the money, and it's very easy to pay. If you have 1,000 rupees, you pay him 100. So he doesn't realize that you're getting your own 100 rupees back. Now, they go and tell their friends, look, I'm making 10%. And so initially there were only 50 people who took the risk. But now they say, look, this is much more. My bank is only paying me so little, and I can get much more. So these 50 people become 500 people next month, and 5,000 people the other month. And even it's possible that the first person comes due, and even it is possible, in order to build confidence, that people say that, look, I want to take my money out. Yes, you take your whole money back, no problem. So this builds confidence. So you run the scheme for about 6 months, and you get huge numbers of people, and then you suddenly disappear with all the money, and you have made a huge amount of money. And you say, oh, sorry, the business crashed, and now I can't make any payments anymore. And I invested all this money in the business, so there's no more money left to pay back. So this is called Ponzi finance. So your earnings is not even sufficient to pay the interest. You're just collecting money. You're not earning anything. So if you need to borrow to pay off the interest, this is called, and even in a real market, when it's really not a Ponzi scheme and you're buying a house, then what happens is that, okay, I will borrow some more to pay the interest, and hope that the house appreciates enough. Of course, no one will lend to you on this basis, but if people are very sloppy, and that is exactly what happened, they say, okay, no problem, you can't pay, I'll just look the other way, because I'm interested in, because see, as soon as I sell this loan for 1,000, 100,000, I can take this mortgage application and I can sell it to the AIG, and they will give me cash 100,000. So all I need is the mortgage papers. I don't need to know whether you have risk or not. Actually, I need, because in the papers also there is a guarantee that this person will pay, and there is a company which provides the guarantee. So this company which assesses the quality, this is also on the game, because they say that if we start saying that this is too risky, then no one will buy our coverage. So everybody has to play the game. If they start evaluating accurately that this loan is too risky, then they will go to some other company, because the bank does not want the company to actually evaluate. They want a paper which says that this is not risky, so that they can sell this paper to the AIG. So the incentives are all wrong. The company which is providing a guarantee that, yes, I've checked the income and it's correct, and I've checked the house and its value is correct, everything, they have the incentive to lie because they want to sell their policy. The bank does not want to know the truth, it wants the paper. So now the thing is that these are as you go in through an expansion, finance becomes more and more risky, and actually what started out as a hedge loan, which was perfectly safe, may become a speculative loan, because the earnings, because if the interest rate rise, if you have things which were introduced which were called adjustable rate mortgages, then the interest rate can fluctuate according to the market, and suddenly what was perfectly safe loan at 3% is no longer safe at 6% interest. More importantly, hedge loans are normally locked in, so that you have a fixed payment, and if your earning stream is also locked in, then there is no risk. So the hedge conversion to speculative is usually not the case. But what happens more often is that the speculative loan, where you were able to pay your interest, becomes a Ponzi loan when the interest rate rises and you're no longer able to even pay the interest. And so now you have to force to borrow. You thought that you would be able to make the interest payments, but you can't, and so you borrow to make your interest payments. So basically, over the period 2000 and 2007, massive amounts of credit became available for housing because of these innovations. We will study this later. Previously, mortgage finance was done only by local banks. If you have a bank, it would finance mortgages in its area only, and it would know the people of the bank, it knows the place, it knows the kind of jobs there are, it knows the neighborhoods, it knows the houses. So the local banks can do a very good job of assessing who are the people who have been living there for a long time, what is the nature of stability, what is the nature of jobs. So they would do a very good job of. So there was very low rate of default on mortgages. When these CDOs came into existence, then suddenly a bank would give a mortgage, and then it would be able to sell the mortgage. And now the incentive became that, and the buyer doesn't know where the mortgage is. So ultimately, the incentive of the bank became that sell the mortgage to anyone at all. So people were walking the streets. Hey, you want to buy a house? All right. So here's this house. You just buy it. What about income? You don't need income. Just bring me $1,000. You need. I will give you a loan, which is a balloon loan. So all you need to do is make interest payments on this. So the Ponzi finance is problematic because ultimately you are betting that 1 year from now there will be somebody who is going to refinance the loan. Lenders will also lend to protect the past loan, that if I let it go, then if I let him default, so suppose somebody comes and says, I need a little loan to pay back my installment. They say, well, I have a lot riding, there's a huge loan on this house, so I better give him the loan. But first of all, you might have gotten rid of it, so you don't care anymore. But next of all, you might say that, okay, the risk that I have from refinancing is more than the risk of default. So especially when you have houses which are underwater, then refinancing doesn't help. So at some point you will stop lending to people who are in Ponzi schemes, and then they will default, and that can create a crisis. So as you go through financial expansion, you get more and more speculative finance, and you get more and more Ponzi finance, and this increases the risks of the system. And collapse can occur from many different possible sources. People were counting on income flows, and these did not materialize, so you are not able to make your payments, or the interest rates rise, or the lenders start becoming more cautious about lending, or some bank defaults, and then suddenly and this can set off a chain reaction. So this is something which people do not understand, and that's why you need to know more about banking sector to understand, because how do crises happen? Well, there was a bubble and it collapsed. Well, this doesn't explain anything. These are the details which explains how the bubble collapses. Why couldn't the bubble keep going? Well, maybe there's a bank default, maybe the interest rate rose and somebody couldn't make. So it's defaults which cause. But the problem is that now in the bubble you have this like the balloon, when the pin is pricked, then suddenly you have an explosion. If there is one institution which defaults, this leads to 1,000 defaults, and that leads to 100,000 defaults, and so you have suddenly this crisis. So once you have this crisis, debtors who were in debt, and now a crisis is happening, they'll say that, okay, I need to pay back my loans, and so you cut back spending in order to make your payments. Previously you were spending freely, borrowing more. Now you can't borrow anymore, so, and you have existing loans to pay off, so your consumption falls. It leads to falls in aggregate demand, which leads to fall in income, loss of jobs, reduction in wages. So now what happens is people start selling things to make the money to pay loans. But when you start selling things, this causes a fall in asset prices. This is the famous deflation, the debt deflation theory of Fisher, which comes into effect here. This leads to wealth being wiped out, widespread bankruptcy, output collapses because now the aggregate demand has fallen, employment collapses because nobody is producing more, and debt increases even more in order to, from the efforts to pay it off. All right. So this is what the crisis looks like. All right. So next, this is, I think we'll stop here, and we will cover the rest later.